please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi there, good afternoon. You're watching Your Stocks. I'm Mangala Malu. With me is Sumaira Abdi. The mid-caps are underperforming. A bit of recovery that we saw on the frontline indices. The Nifty Bank in the green. But it is all about earnings. Edelweiss is the one which is on our radar. Reported an overall strong quarter. However, the net loss for the quarter, for the insurance company had widened. So to discuss the company's performance going forward and in the quarter that went by, we have the chairman, Mr. Rashesh Shah, joining in. Thanks a lot, Rashesh, for joining in. First up, if you could tell us how exactly was the performance of your ARC business, given the sort of resolution news that is flowing by. Earlier, one of your peers also reported their numbers. The ARC business was the one that really performed well. So are you looking at any partnership there and the performance of your ARC business?
As you can see, overall, we have clocked about 46% growth for the quarter as well as for the year. So it has been the best year ever for Edelweiss from a growth in profit point of view, because we have been averaging our profit growth rate at about 35 to 40%. But for this year and for this quarter, it's about 46% growth rate over the same quarter last year and FY18 over FY17. Our ex-insurance profit after tax for the year is now 1,036 crores. Out of this, approximately about 12 to 13% comes from our ARC business. So ARC is about 12 to 13% of Edelweiss profit contribution. ARC has also grown. So the ARC as a whole, last year to this year, there is almost 80% growth in profit. But as you know, we own only 60% of the ARC business. We have a partner called CDPQ, which is the Canadian Pension Fund. They have another 20%, and the other 20% historically is when we started the company, we had given to some of our high net worth investors. So we own 60% of the ARC business. I think the ARC business has clocked the profit after tax of 188 odd crores, and 60% of that flows through into our profits, so it comes to about 120 crores or so. And our overall profit for this year consolidated is 890 crores, and excluding insurance, because we are still in investment phase in insurance, it is 1036 crores. So we've crossed 1,000 crores of ex-insurance profit for the first time, and this is a big breakthrough for us. So 46% growth in profits, but also crossing 1,000 crores of profit after tax ex-insurance is a fairly important achievement for us.
Mr. Shah, just a moment, wanting to divert a little bit to MRF numbers which are flashing for you. While it's looking good on a Y-on-Y basis, this is actually, I think, lower than what the expectation was, because the Kotak estimates that we had actually pegged profit at about 380 odd crores. In terms of EBITDA, the number was close to about 750 crores, so at 680, it's definitely a bit of a miss. Margins as well have improved on a Y-on-Y basis, but it's much lower than the 80-19% that the street was expecting. So it was expected to be a very strong quarter. The expectations were very, very high, and it looks like it's a bit of a miss on that. We'll wait by and see what the realizations are. But for the moment, let's get back to chatting with Mr. Shah about the Edelweiss quarter. Mr. Shah, I was hearing your press conference just a short while back where you've spoken about the growth for your NBFC business, which was at what, some 38% CAGR, right, over the last, 20 quarters. But a lot of that was when you were small. I mean, the business was smaller in size. Are you confident of this kind of growth, given the kind of size that your lending business now has?
Yeah, it's an important question. Over the last 28 quarters, we have clocked in a profit after tax of 38% CAGR. But what is important to note is, in this 28 quarters, the last 4 quarters, which is the year FY18, we have clocked 46%. So in fact, there has been some acceleration in that. But I think going forward, what we have always guided investors is we want to have a long-term profit growth rate of between 25 to 35%. And for the last 5 years, we've been guiding investors on that if you can maintain a profit growth rate of 25 to 35, in some good years, we'll do more than that, like in this year where we got 46% growth. But our aspiration is to be in that 25 to 35, consistent, steady, year after year growth rate.
Right. Mr. Shah, let's also speak about your insurance business. What was the 13-month and the 61st month persistency ratio for your insurance business?
For the 13th month is the one that we calculate, because as you know, we're growing fairly fast.
Right.
We are around 78% on a 13-month persistency, which is also all-time high. A year ago we were at 72, but 3 years ago we were at about 58, 59. So we have improved from 58, 59 to 78% now on a 13-month persistency on that business. Even our insurance business has had a very good growth quarter. In fact, for Jan and Feb, our insurance company was the fastest growing insurance company in the insurance industry as a whole, and we have clocked about 54% growth in APE for the insurance business, and overall our total gross premium this year has crossed 638 crores. So insurance business also over the last 5 years has clocked about approximately 40% growth, but this year has been more than 50% growth on that business.
All right, Mr. Shah, before we let you go, there are a lot of murmurs on the street. Any inorganic growth opportunities? There's a gold finance company on the block. Are you looking to buy it?
We are always careful what we communicate with investors. If there is ever anything that needs to be communicated, we'll be usually the first one to announce it and talk to investors. As of now, there is nothing that we need to announce from an inorganic growth opportunity point of view. As you know, there are a lot of opportunities come. Everybody evaluates all the opportunities.
But you're interested in the gold finance space,
we have not progressed on any opportunity to the stage at which we can announce it to our investors.
You're interested in the gold finance space, right?
We are interested in growing our credit business. Currently, our credit businesses are growing fairly well. Our SME business, our entire retail credit business grew at 81% in this year. So SME, mortgages, agri credit, they are growing fairly well. We are currently not expanding the product portfolio on the retail credit business. The products we have, we are fairly happy with that. And we see a lot of growth in this product verticals in the coming years.
All right, Mr. Shah, we'll leave it at that, sir. Thanks very much for joining in and for taking us through your quarterly performance. I think MRF...
we've gotten some commentary from the management. They've said that escalation in the cost of crude-based inputs remains a concern and will add pressure to the bottom line. So there is some caution coming in from there. They're a little worried about competitive intensity in the industry as well, which they believe that remains at fever pitch. And however, several greenfield and brownfield capacities by many players are expected in the near months, so there in the very near future, in the months ahead. So there is a lot of competition in the industry, and escalation of cost-based inputs remains a concern, will add pressure to the bottom line. From the top line, there is competition, and on the bottom line, there is increased raw material costs. So that is something that the street is a little worried about. Remember, though, the stock is at the high point, or is very close to its record high. Recently hit a record high on April 30th, so some bit of profit taking from there, but concerns of the management not being taken well.
There's just a tad bit of recovery in the mid-cap index, so now down about 100. I mean, make no mistake, it's still down significantly, but from the lows of trade, just a slight bit of an uptick. Let's get started with your stocks. Our two experts have been waiting by. Vijay Chopra and Rajat Bose are with us to answer all the queries that have been pouring in. Our first query comes in from PK Purohit, who writes to us from Gujarat. He says he holds 40 shares of Vedanta at 443 rupees. He's been holding on for about 8 years. It doesn't look like it's gotten him much. He's a long-term investor and wants to know what he should do at this point. Vijay, what's your take? I mean, you know, metal has had a good run, but do you think the time is past to be an investor in these metal stocks?
I don't think so. This is a correction which has happened in the meanwhile, and this correction can deepen a bit further given the global situations. So I think that Vedanta as a stock can slip a bit, you know, probably we can see 260, 265 odd levels coming there. So if at all he can average, because as you say that, you know, the person has bought at a very high price several years ago. So this could be averaged. And I think that, you know, Vedanta as a company is a good company, dividend yielding stock, and can go up in the longer term. So use a correction to average.
All right, use this correction to average. That's a view coming in on Vedanta by Vijay Chopra. But just keep an eye out on a couple of these tire stocks post MRF commentary on cost and increasing competition. The other stocks are not taking it too well as well. So the likes of Apollo, CEAT, Balakrishna Industries, all of them have fallen from the high point of the day, currently trading closer to the lower end of today's trading sessions. There you have it, Apollo Tyres as well as CEAT and Balakrishna Industries. So we'll keep an eye out on this space, increasing competition, increasing raw material prices, not too good for the industry. Let's move on to the next one. We have Ravi K writing to us from Tamil Nadu, holds 30 shares of Adani Ports at 265 rupees for the last 1 year and 5 months. Long-term investor wants to know whether to hold or sell, making 4,000 rupees in profit. So fundamentally, it's result bound. Rajat, the charts of Adani Ports suggest more up move is likely.
An up move could be there, but then it needs to cross 410 to about 420 kind of levels. Once Adani Port manages to do that, you can expect further upside. I would suggest this gentleman to actually hold it with a stop below 360, because in between 390 and 370 there are lots of moving averages, right from 50-day to about 200-day exponential moving averages, and so it should be a very good support area. And since he is in profits, he can continue to hold on. He says he's a long-term investor, should carry on.
Vijay, if someone was to remain invested in Adani Ports, what would be a good time frame?
Well, I think that, that they can be invested, but I think that, booking profits is now a part and parcel of the markets. So markets have become a bit wild, if you see the last few years. So if somebody is getting profits and, I think a stock like Adani Ports, if it reaches around 450 or I think that profits should be booked. So I would wait for 450 to come and book profits there.
All right, book profits at 450. Let's move on. Vinod Zuchi writes to us from Punjab, holds 30 shares of MRF. Oh, surprise, surprise. So he has it at 66,906 rupees for the last 5 months. Long-term investor wants to know whether to hold or sell. Rajat, MRF, what would you do? The stock was at a record high, now a little off post numbers, but management commentary on the industry, raw material prices, as well as the competition has been a little cautious. On the charts, how does MRF look?
Charts, MRF is looking slightly weak. In fact, I would say that once it falls below 76,000, it would be even weaker. So my suggestion is that there are, had it not been MRF, one would have given a straight cut sell call, because at 81,000, the teaser stop that has happened, that suggests that the stock is actually likely to fall further. So if I were in his shoes, I would have booked profits and taken an exit.
All right.
Markets are absolutely flat. Some bit of recovery seen in individual stocks. The likes of Maruti should come up for you. Sharp spikes seen in Maruti just in a couple of minutes from now. There we have it at the high point of the day. Remember, the last two trading sessions weren't that good for Maruti. Yesterday too, after posting record sales for the month of April, the stock did see a bit of correction at the top, and the results too did see the stock taking a bit of a knock. But from there, we're seeing some bit of recovery. We'll keep an eye out on that. But HCC, that is something the street doesn't like one bit. Extended its cut, currently sitting with a cut of close to around 20. At one point, it was down 24% as well. The auditors' concerns with regards to Lavasa not going down too well. But let's move on to the next query. We have Nikunj Thakkar writing to us from Amravati, holds 200 shares of IRB Infra for the last 6 months. A medium-term investor wants to know whether to hold or sell. Vijay, IRB Infra, the company is result-bound today. There has been a lot of action on this stock in the last few trading sessions. Fundamentally, what's your call on IRB?
Well, I think that IRB is one of the major beneficiaries of the infrastructure push by the government of India, and the order book has been very, very sound. So I am fairly bullish on the stock, and I think the results would be good, and the guidance also should be good. So my target for the stock is 310. So in the short to medium term, looks very good on for an upside.
Rajat, your take, you think it makes sense to remain invested for now, or what are the technicals telling you?
See, for the last 1 month, during the month of April, when other stocks have rallied, this stock has been pretty much volatile. I would say that if it were to cross 300 levels in any subsequent rally, then continue to hold on. Else, I would rather suggests that one should get out, because the kind of volatility that is exhibiting, if there were to be any fall, any significant fall in the indices, then this stock may come down to below 250. So it would be better for him to seek an exit in that case.
All right, up next, another query comes in on a company that's due to report numbers. G. Pandyan writes to us from Tamil Nadu. He holds shares in JSW Energy at 64. He's been holding for about 9 months now. He wants to know what he should do at this point in time. Vijay, what's your take? This time around, numbers could look good given the low base. But for a long-term investor, what would the advice be?
Well, I think you should keep on holding the stock, and the numbers supposedly are going to be good. My target for this stock is 94.95, so it should hit there, and he has bought it at a very good price, 64. I think that he should remain invested and wait for the stock to cross 90 and 94 levels, so he can book profits there.
All right, Rajat, would you concur with Vijay on his view on JSW Energy?
Yeah, more or less agree with that. I would put a stop loss below 78 and continue to hold. I'm not projecting higher levels as of now, because my thinking is that within this month there would be a lot of volatility. So maybe immediately you may not see that upside. Immediately there could be some kind of a fall, and if there were to be any, then I would seek an exit and re-enter at lower levels.
All right, gentlemen, thanks very much for joining in and for advising all of our viewers. You have a good afternoon. Thanks very much for watching Your Stocks.